Hi guys, welcome back to another video. So today we're going to do a video all about inflation expectations. We're going to cover what inflation expectations are, why it's so important and why us as economists always bang on about inflation expectations. And then we're going to compare about inflation expectations today to how they were back in the 1970s and how that could potentially affect how the economy is going to move forward today in comparison to how it did back then. For those of you that have done maybe A-level economics or some kind of studying of economics, you've probably heard about the two main causes of inflation. So that is demand pull inflation and cost push inflation. But actually what I think there should be another term in there, and I think it should be inflation expectations. So we've got the following equation. Inflation is equal to inflation expectations, add demand pull inflation, add cost push inflation. For the purposes of this video, we're not going to care too much about demand pull inflation or cost push inflation. Hopefully you've already heard about them, but no worries if not, we can cover those in another video. Today we're going to purely be focused on something called inflation expectations. So back to that equation we were talking about, inflation expectations has a positive relationship with inflation. In layman's terms, what that means, as inflation expectations rises, we expect to see inflation rise as well. Now, what you might be thinking is, I don't understand how me or any other member of the general public, what our expectations of inflation has to do with the inflation of the economy. How does it affect things? So in really simple terms, you can think of it like this. People in the economy work, and if they think that inflation is going to rise in the future, so they think that the central bank isn't going to be good at keeping inflation under control, maybe they lack credibility, then you would realise that your purchasing power is going to fall. And in a way to try and combat that, what could potentially happen is we could get the general public fighting for pay rises. So they're going to go to their companies and say, I demand a higher pay in order to offset this future inflation. But similarly, we get it from a firm's point of view. If they think that inflation is going to rise, if they have got increasing inflation expectations, then what they care about, what do firms care about, are profit maximizers. So they're going to care about protecting their profits, and therefore they're also going to increase their prices to try and protect those profits. But similarly, if it is the case that loads of their workers are coming to them and demanding pay increases, again, they might want to protect their profits there. So they also then raise their prices and pass it on to consumers so that they can protect their profits. Now, in addition to this, it's not just the fact that workers may go and demand higher wages. As consumers, if you think that inflation is going to rise in the future, you might preemptively want to purchase goods now because you're thinking, oh, I don't want to hold out, I don't want to potentially pay in the future when prices are higher, and therefore I want to make all my purchases now. And therefore that also kind of leads in to what's known as demand pull inflation. It all starts off with inflation expectations. Now, as you might rightly be thinking, is why do firms or consumers suddenly get it into their head to expect higher inflation in the future? Now, normally it's not apropos of nothing. There's normally some kind of shock. So back in the 1970s, we had an oil price shock, and this led into this vicious cycle of high inflation expectations and high inflation. And we had horrible periods of stagflation. Now, what the concern is that today is kind of running parallel to that back in the 1970s. We've had the shock, we've had the pandemic, we've had the war in Ukraine. So it's important to think about, well, hang on a minute, how similar is today back to the 1970s in terms of inflation expectations? As we've just ascertained that inflation expectations are incredibly important in terms of affecting inflation. So something we mentioned earlier was this wage price spiral. Now, in order to be able to have these wage price spirals, you kind of need trade unions. Back in the 1970s, trade unions were huge. Trade unions are incredibly important because they give what's known as workers bargaining power. And as soon as workers have bargaining power, we can go into this wage price spiral. Now, back in the 1970s, trade unions were huge. It was something like over 50% of the workforce were part of a trade union. Now, let's compare that to today's time. Actually, it's only around 20% of people that are in a trade union, and we've seen a much bigger increase in terms of people not working for the public sector and being self-employed. So So based on that information alone, we can say that it's highly possible that we could argue that actually the workers' bargaining power today is a lot less than what it was back in the 1970s. So that already decreases the chances of having such wage price spirals. So in addition to looking at workers' bargaining power, what we also need to care about is sort of an independent central bank and their credibility. Why is that? So the Bank of England now is independent, and they have this price stability mandate or objective, which means that their main concern is getting inflation bouncing around 2%. And if they miss it, they have to put out a statement as to why they missed it and what they're going to do in the future to try and achieve that. And why that has been seen as so important, why the literature has gone on so much about being an inflation targeter, is because that is known to help anchor inflation expectations. So even if inflation isn't around 2%, it reassures key members of the economy, so firms, consumers, that at some point in the long run, we're going to get back to that 2% average, and therefore you don't need to be worrying about putting your prices up. So it's called anchoring inflation expectations. So what's important for us to do then is look at how the situation we're in now in terms of a central bank and price stability and inflation targeting, how that compares back to the 1970s. So what's important is that we compare the situation today as how it compares into the 1970s. So today we have this independent central bank. Their main objective is price stability. Their medium long-term average of inflation has to be bouncing around 2%. Now that wasn't quite the case in the 1970s. We didn't have an independent central bank and everything was very government focused. So again, the today's situation doesn't really run as parallel to that was happening back in the 1970s, and what we'd hope is today we've anchored inflation expectations a lot better because we've got that independent, credible central bank. So we've spoken about how important inflation expectations are, and we've kind of spoken about how today differs from the 1970s, but what would be interesting to know is, do inflation expectations differ from the 1970s, and how would you go about finding that? Because maybe it sounds like a bit of like a wishy-washy concept in terms of how are we actually measuring inflation expectations. And obviously that's incredibly important for us to be able to sit and say confidently whether or not we think inflation expectations are anchored, because if they're not, then we have a massive concern about inflation returning to the 2% level. So there are a few ways in which we can go about measuring inflation expectations. Firstly, there's surveys. So in the States, there's this University of Michigan consumer survey, and they ask consumers what their future expectations are about inflation. A nice, easy way to get data on inflation expectations. But that's not the only way we do it. Another way is we actually care about what the financial markets think. What are their expectations on inflation expectations? And the way that is done is in a couple of ways. So firstly, what we care about is we care about bonds, and there are a couple of types of bonds. So there's just your nominal government bonds. Basically, you put money for one and you're guaranteed a certain amount of interest rate for them. There's also what's known as index-linked gilts. And what they do is they promise to give you a real rate of return. And if we take the difference between the two of them, if we do the nominal interest, take away the interest on the index-linked ones, that gives us an idea of inflation expectations. So for example, if we had a nominal government bonds that people are willing to buy for 5%, and then we have these index-linked ones that people are willing to buy for 3%, if you take them away, the difference is 2%. And therefore you would say that on average, the inflation expectation is 2%. Now, the reason why that works is because what you would expect is you would expect someone to be basically indifferent between the two. Well, if one of them is promising you a real rate of return, then the interest or the yield on the nominal one needs to be higher to take into the account that you're going to lose out to inflation at some point. So when you take away the two of them, you're hopefully finding the break-even point, the point at which you're indifference between the two of them. What the data is suggesting at the moment is the data is suggesting that actually inflation expectations are still remaining quite well anchored, which is signifying that we're actually in a different situation to what we were in the 1970s, and that maybe inflation isn't such as a big concern, and it's not going to be this self-fulfilling prophecy, and that we're going to return to 2% in the medium to long term. So I hope that video has given you a quick insight into inflation expectations, what they are and why they're so incredibly important, and a bit more background into how today is contrasting with the 1970s. Bye guys.